Time permitting, we'll try and understand 6 different areas of recent updates. There's been a change in the corporate tax regime in UAE. UAE intends to introduce corporate tax. You may have seen that in some news articles. We'll try and get a little more flavor in terms of what are the set of changes that they intend to bring in. Germany has brought out a certain clarification as regards scenarios where royalty would not be allowed as a deduction. We'll try and get a flavor of what that is as well. CBDT has issued a recent clarification on MFN clause. I would typically not cover India tax matters as a part of this, but given the significance of this clarification and a certain judicial trend that is emerging, I thought it will make sense to briefly talk about this. OECD has also published 2 sets of rules on pillar amount A as far as pillar 1 is concerned. We'll try and understand what the set of model rules are. At the end, we can try and see if we'll try and understand the update around the refund on Kane, the refund that Kane has received. As far as corporate tax introduction in UAE is concerned, I thought it will be useful to understand the preamble or the context that the government is giving. They say that the corporate tax regime is being introduced as a part of meeting international standards for transparency and preventing harmful tax practice. This is coming from the FAQ that has been released. There is also a press release which suggests that it is to execute its support by applying different corporate tax rates to large multinationals that meet specific criteria with reference to the said initiative. What are these 2 points? What is the context? I would tend to believe that this introduction is a response to Pillar 2, introduction of Pillar 2. Pillar 2, as you all are aware, is introduction of minimum corporate tax of 15%. Pillar 2 rules, amongst other things, say that where the jurisdiction does not have a tax rate of 9%, there could be something called a subject to tax, which means there could be a withholding tax in case of payment to those geographies which do not have a minimum rate of 9%. And I would believe that the 9% rate is to address that point. It has also, the rules also say that there would be a certain differential tax rate to large multinationals. As a part of Pillar 2, where a geography is not paying tax at 15%, another group entity would be obliged to pick up and discharge this amount to ensure that the tax rights continue to remain with the geography. In this case, UAE. UAE is possibly introducing these set of rules. These rules would be, or corporate tax would be effective for the period on or after 1st of June 2023. It applies across all the Emirates, and it would not apply to certain categories of businesses. While I say it is not applicable, the existing set of regulations and legislations would apply to certain sectors, let us say banking, oil extraction, etc. There are 2 documents which I have had the chance to run through. One is a press release, a document which is in fairly simple form and language. The FAQs and a press release. The press release is barely a page, which gives some flavor in terms of why this corporate tax is being introduced. The tax rates would continue to be, income would continue to be exempt where it is up to a sum of AED 3,75,000. That roughly translates to about $100,000. Over and above that, income would be taxed at 9%. I did briefly talk about the mop-up tax already. Dividends and capital gains earned by businesses would not be subject to this corporate income tax. Certain intra-group reorganizations and transactions would also be exempt, but those are subject to rules which are yet to be published. Some questions that you may have, basic points in terms of coverage. As an example, there's a free trade zone which is fairly popular, especially multinationals doing business that tend to set up their presence in free trade zones. The FAQ touches briefly on this point. It suggests that the corporate tax regime will continue to honor the CT, the corporate tax incentives currently being enjoyed or offered to free trade zones, and where that entity does not conduct a business in the mainland. With this, I would tend to believe that entities in free trade zones would continue to be exempt, and it is only the mainland that would be taxed. Basic question that would arise to most people is what would happen to transfer pricing? Going forward, after corporate tax is introduced, transfer pricing provisions would be applicable. They are likely to import the OECD TP guidelines like many countries do, saying these guidelines would be applicable, and bring the entire set of guidelines and commentary as a part of their legislation. What happens to losses that have been incurred by a particular company? The FAQ tends to suggest that the losses on and after the effective date alone will be available, which would mean the losses incurred after the point of time when the corporate tax is effective will be when you can start earning and thereafter offsetting losses. There is also a provision to be introduced which will enable group filing. So if there are multiple group entities, you can have a consolidated filing, and it may be possible to offset losses and profits of these entities within the jurisdiction. No withholding tax is sought to be introduced, whether it is on payment to residents or non-residents. That would mean that any future dividend payment, interest payment, royalty payment would not be subject to withholding tax. The FAQ also suggests that foreign tax credit would be available and creditable against any income tax that is payable in the UAE. What about taxability of individuals? While the nomenclature that is used is corporate, the intent is to tax any kind of commercial activity or business activity, whether it is by individual or any other corporate firm. Salary income would continue to be kept outside the ambit. However, any business income where a person has a commercial license or a license to undertake freelancing activity or any permit which permits freelancing, all these incomes would be subject to corporate income tax. Real estate in personal capacity would also not be covered. Similar to the position for corporates, any income from dividend and capital gains would not be taxable in the hands of individuals. Moving on to the next topic, Germany had a few years ago introduced provisions relating to restriction on payments, royalty payments. Very recently, the revenue there, or the Ministry of Finance there, has issued guidance on the rules that have been introduced. These rules seek to disallow deduction on royalty payments to preferentially taxed to companies which are preferentially taxed, directly or indirectly, at a rate less than 25%. Very often, people are very critical about how aggressive the Indian revenue is. Once you start taking a look at regulations and approach of revenue across countries, you may reconsider your thought on whether Indian revenue is being aggressive. I say that because the intent of the rules and some other documents such as the explanatory notes and the memorandum suggest that the rule is intended to cover only IP boxes. However, the explanation broadens it and substantially lowers the benchmark in terms of what would be taxed. It says that any payment or what is a preferential regime? It is not necessarily one which is a payment to a IP box. As long as the statutory rates are different for the stream of income, then that payment can be questioned or challenged by the revenue authorities in Germany. To illustrate, if the normal tax rate is 20% and the stream is offered a beneficial rate of, let us say, 15%, then these payments can be questioned. The deductibility of these payments can be questioned in Germany. They also have some thought in terms of why it is beyond IP box. But on the face of it, it looks like the rule and the explanatory, the intent at the time these rules were introduced to what is being set out in this new guidance is a reasonable amount of gap. There are two parts to this decree. There was one that was released on the 5th of Jan, and the second that was released on the 6th of Jan. The release on the 6th of Jan identifies a set of countries where Germany believes that these are harmful or preferential regimes. And the second part lists out countries which are under review. Most prominently, the first part of the list. This list was already available, I would think, a couple of years back. This list is an updated list which was issued on the 6th of Jan. The updated list includes payments or the tax incentive provided under Swiss law, a certain tax incentive provided under Swiss law. The FDII regime in US is also under review. There is no view that the German authorities have formed on the benefit that is available in US. The CBDT has very recently issued a clarification on MFN clause. The controversy is where there is a MFN clause with the OECD country which says that another OECD member on signing a DTA, if there is a rate or a scope which is narrower, a rate lower or a scope narrower, the subsequent treaty benefits would be provided. This is a MFN clause. This clause is available in countries with Netherlands, France, Switzerland, Sweden, etc. Subsequently, there are DTAs entered into with Slovenia, Colombia, and Lithuania. These countries were not countries or OECD members. So these were not OECD members at the time of signing the DTA with India, and these subsequently became OECD members. The question was whether the benefits available under these three treaties can be imported into the treaties with Spain, Hungary, Switzerland, France, etc. There are plenty of decisions on this issue. I've noted three. The essence of this is to say that it is possible to provide the benefit of the subsequent treaties, which is Slovenia, Colombia, Lithuania. In different cases, different answers, or rather, different benefits were sought under different countries, but the common theme was that the benefit is available and it cannot be denied merely because this country was not an OECD member at the time the circular was issued. Sorry, at the time these were not OECD members at the time the DTA was entered. Recently, a circular has been issued which sets out 4 conditions, which is the belief of the CBDT that these conditions have to be satisfied. One of the conditions is that the OECD member, it should be the third state should be an OECD member at the time it is signing this treaty. Also, a separate notification is required to be issued by India, enabling it to import it into the original treaty. Shortly, this circular was issued in the first week of February. Shortly thereafter, there is a ruling by the Pune ITAT within a couple of weeks' time, where the ITAT has noted the circular and has said that it cannot be retroactive, that a legislation attaching additional disability cannot be retrospective without a clear legislative intent. I am mindful of the fact that I am over time. I will pause there. Bharat, over to you. If we have time, if we have 3-4 more minutes, I will cover another topic. But
please no need. Maybe a few minutes more. Yes.
OECD has published 2 draft rules as regards the first pillar. As you are all aware, Pillar 1 applies or is intended to be developed as a part of a solution for addressing tax challenges from digitization of economy. Pillar 1 would apply to certain MNEs which have a high level of profitability. There are certain qualification conditions on when these would apply. Safe to say that these are for large multinationals. As long as the profitability is greater than 10% and the global turnover is more than 20 billion euros, these rules will kick in. The profits would be reallocated. Profits of such multinationals would be reallocated to markets which would be calculated at 25% of the profits over and above 10%. A certain subsidiary body of the Inclusive Framework Committee has been charged with developing the framework on how these need to be implemented. There would be a multilateral convention and explanatory note. There would be rules and a commentary to the rules. What is now being issued are the model rules. It is not possible. The approach that is being adopted is a rolling consultation. In the sense, certain parts would be issued periodically and a very short time interval would be provided for comments to be provided. As I gather, there would be 13 set of such issuances, and once feedback is received, the final rules would be provided based on feedback from various stakeholders. What is being issued is a work in progress, and there are plenty of caveats in the documents of the consultation paper. 2 sets of articles have been issued, or consultation papers have been issued. The first one was issued on the 4th of Feb, which includes 2 articles, one pertaining to nexus and the other pertaining to source. When I say nexus, it means whether this income or whether a particular country meets a certain level of threshold for it to be eligible as a market geography and for the amount to be reallocated. If that basic threshold is not there, if it does not meet that basic threshold of nexus, then that reallocation may not happen. The threshold has been set at 1 million for jurisdiction with a GDP of 40 billion and $250,000 for countries where the annual GDP is less than 40 billion. For the nexus, one would have to look at whether there is source, whether there is income or a source from that country amounting to the amounts which I just said. And how do you determine whether there is a source? There is a certain methodology which is prescribed. They say use the information that is available to identify whether this stream of income is from a market jurisdiction. There could be multiple indicators. They've illustrated the set of indicators that can be used. They also go on to say if there is a particular income which cannot be allocated, use an allocation methodology to ensure that no income of the group remains unallocated. So the total income stream has to go into one bucket or one country or another. It cannot be sourceless. There is a detailed schedule which outlines how these rules have to be applied or source has to be applied. The determination on income or revenue is by a transaction by transaction basis and not by virtue of contracts or agreements. As an example, if you have an income stream from an ad and if it is based on a click, you will have to determine what is the geography in which that click has happened, and that income would be a source from that geography. It would not go by the invoice. There could be a consolidated invoice across multiple countries on a third country. That would not be relevant. Source for this purpose would be the click. In various cases, different parameters have been set. This is an illustrative example I'm using to drive home the point. The intention is to not retain data at an itemized level, but more at assess the requirement at a system level or the compliances in terms of checks and balances that the system has. There are 8 different types of delineated revenues. I will not go into the items. I will share the slide deck and you can go through this. There is another rule that has been published to determine what is the tax base. And this tax base would be used to determine the amount, the profit that needs to be allocated or reallocated. The starting point would be the consolidated financial statements prepared as per qualifying financial accounting standards. Ind AS would qualify as a qualifying accounting standard has been notified. The rule observes that it is sought that the adjustments would be kept at a minimum, but I would believe that there is a fair bit of complexity. As a takeaway, what I have set out here is that the number of computations each person would need to prepare. From one financials, you would start with the financial statements. You would have your computation for corporate income tax. You would have a separate computation for Pillar 2, another computation with a different basis for Pillar 1. And if it's a country or a geography where there is a minimum alternate tax, you would do another base. Each of these would be a different tax base. Suffice to say that the complexity with time only keeps increasing further and further. On that note, I will stop and hand the baton back to Bharat. Thank you and sorry for the overrun.
See, as you are aware, the provisions relating to charitable trusts and Section 1023C institutions, especially those which are enjoying exemption under subclause 4, 5, 6, and 6A of Section 1023C, have been in the eye of the government for a thorough review, because the government feels that many of the institutions are misusing the exemption given to them, and day by day they want to tighten the control over these institutions. With this in mind, what has happened is there have been substantial amendments to these sections first by the Taxation Laws Amendment Act 2020, which we will call TOLA for short, then by the Finance Act 2021, and now what we are having today, that is the Finance Bill 2022, which will shortly become an act. And it is it's a no-brainer to say that whatever the proposals are there would be accepted and they would become the part of the statute. So under these three statutes, an exhaustive review has been undertaken by the government, and then they have made the amendments to this one. So what we will look at today is what are the amendments made under each of these statutes, what are the specific issues that arise because of that particular amendment, and then we can discuss what are the possible solutions or possible answers to various questions that I would be raising, but not promising to answer. Okay, I will raise only questions and the answer should come from you. So next slide, please. Yeah. Now what TOLA 2020 completely revamped the procedure for obtaining a registration by a trust under Section 12A and by institutions under Section 1023C. When I say a 1023C institution, for the purpose of today's discussion, it always refers to those institutions which are mentioned in subclause 4, 5, 6, and 6A of Section 1023C, and not 1 to 3AE. So therefore, whatever discussions we are going to have, will be applicable only to these institutions. The major amendments which have been made for the registration is that all existing trusts and institutions which are registered or approved should file a fresh application for registration, which was initially on or before 30th June 2021. Due to COVID, it has been extended over a period of time, and the last date for filing such an application by the existing registered trusts is 31st of March 2022. So I'm sure most of us would have advised our clients who are charitable trusts to file the application for renewal, and in case anyone has missed it, please do it before 31st March 2022, because if the trust is not registered or the institution is not approved again, you lose the benefit under those sections. Next one, please. Now, if you are a trust which has been granted a registration under the new procedure given in section 12AB, which may include a trust which has been whose existing registration has been renewed, and the period of registration is going to expire, then you have to make another application for renewal. That means, unlike the present regime, where a registration under section 12A is during the lifetime of the trust, under the new regime, the registration will be effective only for a period of 5 years, as we will see later, in the case of a final registration, and 3 years in the case of provisional registration. So if you are already registered under section 12AB and your registration, let's say, is going to expire sometime in December 2000, or let's say March 2027, then you have to make an application before 1st October 2026 for renewal of that registration. So it is very clear that the renewal is only for a specific period and you have to keep on renewing it every 5 years, and such an application should be filed 6 months prior to that. The next one would be that, as we would see, that when you are making an application for the first time for the registration, the commissioner does not give the final registration as such. He is going to give you only a provisional registration, and the provisional registration validity is for a period of 3 years. So if you are provisionally registered, then what happens is that you have to file an application 6 months prior to the expiry of the provisional registration, or within 6 months after commencement of its activity, whichever is earlier. Now, what is this within 6 months after commencement of its activities? It would mean that where you are, if you apply for a registration as soon as you are incorporated or formed, the commissioner will give you a provisional registration for 3 years. But within the period of 3 years, you have commenced your activities of the charitable nature. Then what the law requires you is to make an application for final registration, converting the provisional registration into a final registration within 6 months from the commencement of its activities. So there are some issues on this. We will discuss it later when we take up issues separately. Can I have the next slide, please? Then there is another one where any institution or trust which is registered or which is granted approval by the board under section 1046 of the Act. Today there is a prohibition from claiming exemption under section 11. So because section 11.7 would say that once you are claiming exemption under section 11, you are not entitled to the claim exemption under section 10 in respect of any income except agricultural income. So if you cannot claim a 1046 exemption if you are also registered under section 11. So many institutions, what they would do is that they may prefer to be under section 1046 and therefore continue to claim exemption under that section. But if for some reason these institutions who are approved under section 1046 wants to come to section 11, then they have to make an application within 6 months prior to the commencement of the assessment year for which the registration is sought. See, for instance, if you are looking at a registration of for assessment year 2026-27, then you have to make the application 6 months prior to the commencement of the year, that is 1st April 2026, means by 30th September 2025, you must make the application saying that I don't want to be under section 1046. I want to come under section 11, so to grant me registration. Then Another case where we have to make a fresh application is that if you undertake the modification objects of the trust or the modification of any of the conditions of approval given by the commissioner, then you should file the application within 30 days from the date of adoption of the modified objects or the modification of the conditions. So this also you have to keep in mind that in case it is not only the change in objects, but also it is a modification of any of the conditions. Next, please. Now, if you just go back to the earlier slide, kindly go through that. These two conditions, section 1046, conversion to a section 11 institution, or the modification of the objects, etc., these two are not applicable to 1023C. So you don't have to make an application because the 1046 to 1023C is permitted by getting an approval under section 1023 per se, and you don't have to make an application like this. Yeah, please go ahead. Next one. And if you are making a fresh application, you are a new trust which has just been formed, then you have to make the application 1 month prior to the commencement of the previous year, relevant to the assessment year for which the said registration is sought. Here also we have certain issues. I would explain this particular clause with reference to an example which will make things very clear to you. Next slide, please. Now, section 12AA5 has been introduced to provide that the provisions of section 12AA shall not apply on or after 1/4/2021. So what is the effect of this? That after 1/4/2021, no proceedings can be initiated under section 12AA1, either for registration of a trust or for cancellation of registration of a trust, either at 12AA3 or 12AA4. So therefore, and what happens to the pending proceedings before with the under section 12AA as on 1/4/21 is a matter which we have to discuss, which we will do it a bit later. Now a new procedure has been introduced, section 12AB. Similarly, the second proviso to section 1023C deals with the new procedure, what the commissioner should do on receipt of the application. We saw there are 6 situations where you have to make an application. So on all those 6 situations, section 12AB tells the commissioner to proceed in a particular manner. When you are seeking a registration, a renewal of registration of an existing registered trust, then the commissioner has to automatically grant the approval. He has no role to play on that except to act as an authority granting. He cannot ask for any information. He cannot ask for any. All he has to see is whether you are already registered, either under section 12A earlier or 12A1AC read with section 12AB. So once you are registered with that, then if you're asking for a renewal, then the commissioner has to simply pass an order granting you registration without asking any questions, no inquiries. Next slide, please. Next. No, I think you go back to the earlier one. Now, in a case where the registration has already been granted on 12AB and you want to renew it, and in a case where the provisional registration is to be converted into a final registration, the commissioner can call for such document. Contrast it with the earlier one. Existing registration trusts, registered trusts which are making an application for renewal for the first time on or before 31st March 2022, the approval is automatic. But any renewal thereafter, or in a case of conversion of a provisional registration into a final registration, the commissioner has got certain powers. He can make inquiries, he can call for such documents or information as may deem necessary, basically to satisfy himself regarding genuineness of your trust, and that if any other law is applicable to you, whether the requirements of those law which are material for the purpose of achieving the objects of trust has been met by the trust or the institution. Say, for instance, if you are an educational institution running a medical college or engineering college, the All India Technical Education Council or the Medical Council of India are all the authorities having jurisdiction over you to ensure that you provide proper education and facilities. So if any of the requirements under those law are not met, then the commissioner can make an inquiry and find out whether it is met or not, and those conditions should be material for achieving the objects. Now, we have discussed this when this particular similar provision was made by the Finance Act 2019, when it brought in all these kind of this one. So there are a lot of issues on this, that at what point of time the commission, how can the commissioner decide anything which is material for so those are the points which are already discussed earlier. So I will not go into that. I'll just take the 12A one say. What it says very clearly is that 12AB. And unlike some other sections which you will see later, that in those cases where the authorities under those acts have held that you have not satisfied some of the conditions and such an order or direction of those authorities have become final or not disputed by the trust, then the commissioner can take some action. But nothing like this here. Here it is a very subjective satisfaction of the commissioner that you have satisfied all those requirements which are material for achieving your objects. So the other law has to be, and the conditions imposed by those authorities have to be interpreted by the commissioner, and how far his interpretation is right, how he will view that, what will be, whether they are material for the achievement of the object. These are all going to be the friction points between the assessee and the department, where there is likely to be a lot of dispute. Next one, please. Then the commissioner says, okay, after looking at all the documents, inquiries, and the examinations he has conducted of this, he is satisfied the registration is to be renewed or a provisional registration is to be converted into a final registration. He will give an approval for a period of 5 years. If he is not satisfied, he shall pass an order in writing rejecting such application and cancelling his registration after affording a reasonable opportunity. Now, what is the effect of this cancellation? Why should he cancel if he is not renewing, just because he is not renewing your application for registration? There could be a couple of reasons. One is that you are not a genuine trust and he has come across some material which proves that fact and it has happened earlier. Or in the case of a provisional registration being converted into final registration, he feels that you are not entitled to that and therefore the provisional registration gets cancelled. So these are the possible, but then we will see later that there are certain specific procedures and sections which have been brought in to deal with the cancellation of a registration. The commissioner must follow those procedures. He can't simply say that I am satisfied that you are not eligible for renewal and therefore I am cancelling it. He may say that you are not eligible for renewal and it should stop. The cancellation of registration according to me, has to be in accordance with the other provisions which deal specifically with cancellation. And this power of cancellation is not something extra given under section 12AB, but it is something which only enables him to take action under the other relevant provisions like the amended section 12AB4, etc. Okay. Now we'll come to that. Next one, please. Same way the inquiry, etc. when you want to convert into section from 1046 institution to section 11 institution and want a registration under section 12A. If you are making an application for the first time, you are an unregistered trust or you have been just formed and you are making an application for registration, the commissioner will grant you a provisional registration for 3 years from the assessment year for which the registration is sought. And here also, practically no inquiries will be conducted at this stage. The inquiry, anything which the commissioner wants to conduct, is to be only when the provisional registration is to be converted into a final registration. For granting provisional registration, it is almost automatic, like the first time renewal of the registration, which is to be done when you file an application on or before 31st March 2022. So this can happen, this fresh registration can happen under two circumstances. One is that you are an existing trust, but you are not registered at all so far, and you want to register it now. Or you are a trust which has just been formed in the recent year, and therefore you are making an application for registration. So under these two circumstances, the last clause will apply and the commissioner would grant a provisional registration. Next one, please. Now, any pending application before the commissioner on which he has not passed the order under section 12AA granting registration or refusing registration shall be deemed to have been an application made under section, that is the last limb of section 12A1 AC, that is any other case, and accordingly it will be dealt with it. There are certain time limits for the commissioner to pass orders under section 12AB. One is the application by the existing or registered trust institution, that is 31st March 2022, on or before that, when you make the application, 3 months from the date of the receipt of the application, the commissioner must pass the order. Next slide. Where he has to make an inquiry, like in the case of a conversion of a private provisional registration to a final registration, or a renewal of a registration granted under section 12AB, 6 months from the date of the receipt of the application. And in any other case, it is 1 month from the date of the receipt of the application. Sections 12AB4 and 5 deal with the cancelling the registration under certain circumstances. We will see them, discuss them separately. At the moment, we'll just know that there are certain cancellation provisions. Now, you may note here that the TOLA 2020 introduced section 12AB4 and 5. Now, the Finance Bill 2022 has completely revamped subsection 4 and 5 of 12AB, and they are given a very elaborate procedure for cancellation. Whereas if you look at the earlier 12AB4 and 5 as introduced by the TOLA 2020, there are hardly any procedures mentioned therein. Okay, therefore, though I have not put this in the slide, we may have to discuss what is the effect of the pending proceedings initiated under the either old section 12AA3 for cancellation or under 12AB4. If after 1/4/2021, before 1st April 2022, if there are any proceedings have been initiated for cancellation, and if those proceedings are pending, how they have to be dealt with after the Finance Bill 2022 becomes an act. That I have not discussed in the slide, but we will discuss it separately. Next one. Now let us look at certain issues on registration procedure. Now, as we saw that under 12A1 AC3 deal with conversion of a provisional registration into a final registration. It says the application is to be made within a period of 6 months before the expiry of the provisional registration, or within 6 months from the date on which you commence your activities. The question is, what happens in the case of a trust, an existing trust, either it is which is not registered, or a trust whose registration has been cancelled but makes a fresh application for registration from that date. So in this case, what happens is the commencement of the activities happened far back in various years, much earlier in the various years. So that 6 months period of the commencement of activity limit cannot apply to an existing trust which seeks the registration for the first time, or a trust whose registration has been cancelled and makes a fresh application for registration after cancellation. That 6 months period of with reference to commencement of activities cannot be implemented at all, because it is beyond one's powers. It is, the law cannot expect you to do the impossible. So therefore, this activity of period of limitation of 6 months can only be for those trusts which have been formed, incorporated, or formed recently. So you make an application as soon as you make form the trust, then you, because on that day you won't have commenced the activities. When you commence the activities, within 6 months from the commencement date, you have to make the application for conversion of the provisional registration to final registration, even though the period of 3 years has not expired. Please keep this in mind, that if you are a new registration, if you have sought for a provisional registration given, you cannot wait for 3 years. The moment you start the activities, your meter starts running for making the fresh application for conversion of the provisional registration into final registration, and that period of 6 months will start from that date. So within 6 months from the date of the commencement of the activities, you have to do that. Now, some of you may ask me a question. So what is this commencement of activities? What does it mean? Commencement of activities means whether it's carrying out the preliminary activities which is required, or whether it is carrying out the carrying out any of the objects. Okay. For instance, if your object is to provide education, whether is it said that you have commenced your activity when you purchase, let us say, the land or building to house the school or college, or whether it commences only when you start admitting the students and providing them education. So this is not very clear. Prima facie, I would take a view that even if you take any of the preliminary steps to effectuate your objects, you better file the application for final registration and don't wait till you actually start, commence any of the objects of the trust as such. Like in this case, example I gave you, like you start the school, get the students into the class, and then start teaching them. Don't wait until then. Even if you take the first step of buying the land or building or renting them out, I think the commencement of the activities would have commenced. And therefore, it is better to be on the safer side, because anytime the commissioner can say that you are not done within 6 months, and therefore I will reject your application. So it becomes a problem. So you have to make a fresh application again. So you get into a sort of an unnecessary tangle. So there. Now, one more thing we have to understand is that I have always been referring to an institution whose registration has been cancelled making a fresh application. I would like to inform you that there is absolutely nothing in the Act which prohibits such a trust from making an application, even though its registration was cancelled either under old section 12AA or under new section 12AB. Okay. So even if such an institution whose registration was cancelled makes an application, the provisional registration will be granted for a period of 3 years. Next one, please. This the first point I have discussed. Next one. This already discussed. Now, look at the wordings of section 12A16. In the case of a new trust formed in a financial year, it looks like that it cannot claim the exemption under section 11 for that year, for the very simple reason that it cannot get the registration for that year. Let us look at an example. A trust is formed in June 2022. The trust wants to claim registration for assessment year 23-24 because the relevant previous year would be from 1st June 2022 to 31st March 2023. The relevant previous year for assessment year 23-24 is April 22 to 31st March 23. What section AC16 says is that you have to make the application 1 month prior to the commencement of the previous year in which you are seeking registration. So what is the previous year registration? In this case, the previous year is 22-23. So what is 1 month prior to the commencement of the financial year 22-23? It is 29 February 2022. So that is how the one. Therefore, what happens on 29 February 2022? You are not, sorry, 28 February, not 29, sorry. On 28 February 2022, you are not even in existence. How could you have made an application like this? You couldn't have made an application. And therefore, what happens? As the law stands today, you may not get the benefit for the assessment year 23-24. This was pointed out when the TOLA itself came, but so far no amendment has been made. We hope that the Parliament will wake up to this issue and make it as 1 month prior to the commencement of the assessment year, not the previous year. Please, next slide. This is what I have explained in the next slide. Next one, please. Another issue is that when you convert a provisional registration to final registration, the approval is for a period of 5 years. 5 years from when? Is it from the date on which the earlier application was made, or is it 5 years from the date of the application for conversion, or is it 5 years from end of the provisional period of 3 years? It is not clear. Possibly one can take a view that it should be 5 years from the expiry of the provisional registration. But then there is a practical problem in this. What happens if you have already made the application before the expiry of provisional registration? That is, on commencement of your activities, you have made it. So whether it is 5 years from the date of that particular application seeking the conversion of the provisional registration to final registration. Is it with reference to that particular year? They will say from that year you are getting 5 years. So this is something which needs to be clarified, and we also should know that how the commissioners deal with this. Existing orders, how they have done that, we have to see that when you make this application, because this is something which came only about 2 years back, and it's very likely that practically there won't be a case where you are sought for conversion of a provisional registration into a final registration and the commissioner has passed the order. If any one of you have received it, such order, kindly share that experience with us. Next slide, please. Before we go here, I will stop for a moment, and if there are any questions, I would take them now with reference, but please confine your questions to the topic discussed, that is the registration procedure. So if you have any doubts, or if you have a view which is contrary to what I have expressed, you are free to do so. Please, you can send your questions to the organizer. I am sure they will be able to.
Sir, I have Ashok Sharma ji from Bombay. I will just allow him to speak. Just a minute.
Yes, Mr. Sharma ji, how are you?
Sir, just a minute. Sharma ji?
Yes, can you listen me?
Yes,
yeah,
Sharma,
I can listen.
We can hear you. We can hear you. Please.
Sir,
Please.
this issue you are not discussed, but it is related to registration only. This issue had arisen when we are applying for registration. In the trust deed, if there is no clause of irrevocability, then what is the position? From various platforms, it was opined that if that clause is not there, you may not get registration, etc. But I am told, but my understanding is charitable trust by itself, its nature is irrevocable. So what is your views on that, sir? If
Yes,
it is,
there are anyway. Good evening, Mr. Sharma ji.
yeah.
Long time I have not talked. So
Yes, sir.
nice to hear your voice. See, the first
Yes, sir,
point
thank
according to me is this: there is nothing in Section 11 or anything which says that your trust or institution there should be an irrevocability clause. But what is happening is that in practice, the commissioners, before granting approval, this is from time immemorial when the registration proceedings started under old Section 12, the commissioners used to insist that you should say that trust is irrevocable. Okay, but according to me, the commissioner has no power to say that. There is, if a trust which is a charitable trust, if the author of the trust revokes the trust, there is nothing wrong with that. But today in the Income Tax Act, you have some serious consequences of Section 115 TD, that the accretal tax being levied on the trust, etc. Subject to that, there is nothing. But in Karnataka, I believe there is a law which says that if any property has been transferred to a charitable trust, and later if it is been transferred by revoking the trust, the DC's permission is required or the court's permission is required for under the Civil Procedure Code, and therefore you cannot revoke it by yourself. This is subject to the local law. Assuming there is no local law, according to me, the department cannot insist on irrevocability. If it is revoked, then the consequences will follow. Either 115 TD, and then after the revocation, you will not get the benefit of the Section 11. That's my view.
Yes, sir. In case that clause is not there, what is the advice, sir? Should we make a supplementary agreement? But because that is to be made by settler, so how can it be made now? Trust must have been created much before.
Yeah, this normally in many cases, what the settler would be available, because you make the application immediately after the trust deed is drawn up, and therefore the settler has powers to amend the trust deed to, because even in, see, today what we do practically, sir, is this. We have certain, we know that the department is insisting on certain standard clauses in the trust deed. Like one of the clauses they require is that nothing in the trust deed will be changed without the prior permission of the commissioner. We tell the client saying whether you want to comply with this requirement or you want to challenge it. Because if I don't put it, he doesn't give me the registration, then I have to file a writ petition in the High Court saying that he has no such powers to do it. Okay. Or I have to file an appeal to tribunal saying that he's not. So many of the settlers, what they feel is that they don't want to get into any litigation when they just start the trust. So therefore, they say, all right, let us have it. But in law, the commissioner, according to me, cannot prescribe any conditions which are not statutorily laid down. But therefore, it's a matter of convenience. It's a matter of practicality, whether you want to litigate or you don't want to litigate. If you don't want to litigate, comply with the requirements. If you feel that, yeah, I can litigate, then you can file an appropriate steps on that.
Right, sir. Thank you.
Sir, we have some questions in the chat box and Q&A. Would you want to take it, or we'll move
Yeah,
ahead?
I'll take it. If it is with reference to procedures of registration, I'll take it, because anyway, we are going to have another session later. So I would like to take the questions.
Right, sir. Sir, I'll just read out the question. Can you see the questions, sir, on the screen?
It popped up, but then it was not full.
Okay. How is it now?
No, now I am not able to see it. Nothing is there.
Okay.
It's in chat box, sir.
Sir, I will read it out nevertheless.
Yeah, sure.
Yeah. There are several judicial precedents which state that registration needs to be granted irrespective of presence of such a clause or not. Same issue was arising with respect to the dissolution clause. Sir, I think this is what you mentioned.
Yeah. I agree with that.
Right, sir. So there is one question in the Q&A box. Yeah. The approval under section 1023C was granted in September 21. Now we want to shift to registration under section 12A. How to go about it? So would you want to take this up now, or maybe we'll consolidate it and take it up later?
No, it's okay. This is something which is
Connected, yeah.
Connected. So we will do that. See, as we said that there is nothing in section 1023C which says that you cannot cancel the registration yourself and then seek the section 12A registration. In fact, there is the decision of the Andhra Pradesh High Court in the Andhra Pradesh State Pollution Control Board. What they want to do, they were an institution which is registered under section 1023C. They wanted to make an application under section 1046 to the board to get registered under section 1046. The commissioner said that I will not permit you to leave section 1023C regime. And the department took us, when the assessee challenged that order before the High Court, department took a stand that the cancellation of registration approval under section 1023C is the prerogative of the department, and it is not at the option of the institution. The High Court rejected this argument of this one and said there is nothing wrong in asking for cancellation and moving over to 1046 regime. So in my view, you can ask for a cancellation of the approval under section 1023C and make a fresh application under section 12A 1AC clause 6, and the commissioner has to deal with it in accordance with section 12AB. So what applies to 1046 should apply to section 11 also.
So then the supplement to that question again from Mr. Rakesh was in the past the return has been filed and was assessed under 1023C 6A.
Correct.
That,
no, but this can only be prospective. That's what I'm saying.
Yeah.
See, this application can be only prospective, and you will have the Same problem as I was mentioning about the last clause of section 12A1 AC 6. That is, the year in which you make the application, you may not get the benefit. And if you get your 1023C cancelled in that year, then for that particular previous year, you may have a serious problem of getting the exemption. That's a practical problem. Unless that particular 12AC16 is amended, then we are stuck with that problem.
And so I think then we can move ahead, sir. Those are the questions that we had for the time being.
There is another question which has come from Navneet. Can you read that?
Yeah, sorry. Yes. Any application has to be made 30 days prior to the commencement of the previous year. How would this condition be satisfied in case of a newly set up company, say in April 22?
That's what I mentioned in my example. I had given very clearly that that in the year in which you make the application, you may not get the benefit because it is 1 year prior to the commencement of the previous year relevant to the assessment year. I gave that example, which if you can just go back to that slide, it's about 2 or 3 slides back. This is the one.
This one, yeah.
Even the earlier slide will give the dates. Just take the earlier slide. So that's what I have said, that this is a problem which needs to be addressed by the Parliament, and the necessary amendment has to be made to that section. Yeah, if there are no other questions, then we can go to the next topic.
Yes, sir, we can go.
Yeah.
Can one say that the activity or the previous year is to be understood with reference to commencement of activity, and the application made 30 days prior to any kind of activity being undertaken would meet this requirement? Otherwise, the provision in some sense becomes unworkable.
Yeah, I agree with you, it becomes unworkable, but look at the language of section subclause 6. In any other case, at least 1 month prior to the commencement of the previous year relevant to the assessment year from which the said registration is sought. So there is absolutely no reference to activities in these matters. The activities are referred to only in subclause 3, which deals with a conversion of a provisional registration into a final registration. And therefore, on a very literal reading of clause 6, it is this. But then if the courts may say that, okay, we have to do some violence to the language, we will read the this one as a, instead of previous year, we'll read it as yes, sir. Next one.
The question was more to say, can I say that the previous year, normally the provisions or the logic that we would apply in case of a business setup, that only after the business has been set up would the previous year start. Can we use the same rationale?
Yeah, if you're looking at section 3, yes, the previous year can start only after the business is set up. But then the question here is that here the trust has been formed in the previous year. So the activities commencing and the business setting up may not be because there the problem would be that, because whether you're going to treat the activities as setting up of the trust or the establishment of the institution itself as a trust, as an activity, it's an issue. We can take a view like that, but it would be much more better if the law is amended to make it very clear to ensure that these kind of unnecessary disputes don't arise. Because as the law stands today, it is asking us to do an impossibility, to make an application before even I was born. Yeah. Now let's go to the amendments made by the Finance Act 2021. Can you have the next slide, please? Section 1023 3AD and 3AE, which refers to those educational institutions and hospitals where the annual receipts are less than 1 crore, there is no need to get the approval of the prescribed authority at that time, today the commissioner. And what was happening was that the courts, including the Karnataka High Court in Children's Education Society, held that 1 crore limit is to be with reference to each institution. Suppose the trustees run 5 different institutions. For each of them, you have to apply for 1 crore limit. And if less than 1 crore, then you don't have to get the approval of those schools or institutions whose less than 1 crore. And if any of them have more than 1 crore, then you have to go and apply for that. So this was the view taken by many courts. Okay. Now, by the Finance Act 2021, they amended this to say that the limit will be 5 crores with reference to the person who is in receipt of the income. So that is the trustees. So therefore, the persons who are in receipt of the income under 1023 3AD and 3AE, now the limit is with reference to the person. It is now made clear that the limit is not with reference to the institution. Since they are clubbing, aggregating all the institutions together, they have increased the limit from 1 crore to 5 crore. So this is an amendment which is made in Finance Act 2021. Let's see what are the issues arising out of this. Next slide, please. Yeah. But then, okay, fine. The amendment says that, okay, you compute the limit with reference to all the institutions run by the trustees, who are the persons in receipt of the income. But what kind of receipts will fall within this limit of 5 crore? Whether all the amounts received by the trust would come under that, irrespective of the fact whether that amount is relatable to the institution. Suppose you are having a trust, your trustees are running educational institutions, there's also a trust which is there. The educational institutions receive school fees. They receive certain other fees from this one or certain direct donations in respect of those institutions. But the trust also generally receives donations from public or from other parties which are not specifically meant for education. So in this case, the question is whether that 5 crore limit is with reference to all the institutions, or is it with reference to, with reference to all types of receipts, or only those receipts which are connected with the institution. So this has not been addressed by the amendment, but just as a matter of information, I would like to say that there is a Allahabad High Court judgment on this point, even with reference to 1 crore. Just take the next slide, please. In Mana Seva Samiti 439 ITR 79, the court held that you have to calculate the fees relating to that particular institution. So applying the ratio of this decision, we can say that the 5 crore limit is with reference to the fees relatable to the institutions which are mentioned in 1023 3AD or 3AE, and not to the other types of receipts received by the trustees, like donations from public, interest on fixed deposits or other investments which the trust has made, or any other receipts which are not connected with the institution at all. So this is something which has not been addressed, fortunately. So we can take the benefit of this decision and argue that 5 crore limit has been computed accordingly. Next one. Sorry, there is a small typo here. Then the question would be, what would be the taxability of the other receipts? There is a question there. What I would like to say is this. This is a very interesting point. One way of looking at is that the exemption is with reference to the receipts, but it is received by a person who is running the educational institution, and the exemption under section 1023 AD or 3AD with reference to persons, and therefore it is available. But this I am only just thinking on my feet and answering this question, but there is a serious issue on this, as the department may say that since you are confining yourself of the limit to the 5 crore only with reference to that institution, then anything extra you receive is income, because you can't get exemption under any other section. Once you are at 1023 AD, you can't claim it under section 11. So here what will happen is that then we have to examine. I have not examined this. We have to think whether in respect of if there are other activities I'm carrying on as a trustee, whether I can get exemption registration under section 12A for those activities, and in respect of the institutions claim under 1023C. Looking at section 11.7, it may be a very difficult proposition, but honestly, I have not applied my mind to this. It's a very good question. I need to think about it, but I have given you my initial reaction, which may not be, which may be subject to any interpretation. Fine. As I said, that these are all interpretations on which it's a possible interpretation. I'm not saying that the exemption would be available. I'm only saying that this is one possible view, but one has to really look into that. Since I have not applied my mind on this, I have to look at the exact language of section 11.7 to see whether I can get an exemption separately, registration separately for those activities, and continue the activity under 1023C, 3A-D or 3AE or not. If not, possibly the income would be taxable. Yeah. There's a small typo here. It is section 1023C, not 1223C. According to the explanation, which was added, the calculation of income which is required to be applied for accumulated during the previous year should be made without any set-off or deduction or any excess application of any earlier years. Similar explanation was added in to section 11 by adding section explanation by. You are aware that almost all the tribunals and a few courts also have consistently held that if there is an excess application of income of a particular year, in excess, suppose you are supposed to apply 85%, assuming you applied 92% or 95%, that extra 10% which you applied in a particular year can be used as an application of a subsequent year's income. For example, you have let us assume that in the year 1, I have an income of 100 rupees and I have applied 90 rupees. So, but law expects me to, law requires me to apply only 85 rupees. So there is an excess application of 5 rupees. In year 2, as against 100, I have actually applied only 8 years of that income. The question is whether the 5 rupees of the excess application of the earlier year can be brought forward and claim that in this year that also should be added to the 80. So I have satisfied the condition that 85% of my income I have applied during the current year, and the courts have held yes. As I said, on this issue, yes, there can be any number of arguments saying that if you look at the language of section 11, all it says is out of the income, you should apply the, that means what should be applied is the income. And normally, since we are dealing with each assessment year is a separate self-contained unit, one can argue that the income of that year alone should be taken into account for calculating the 85%, and there is no specific provision for carry forward of the excess application of the earlier year. But without really examining these issues in detail, the tribunals are holding in favor of the assessee, saying that you can claim the set off of the excess application and treat it as a current year application. So subject to this, whether this is a right view or not, for the sake of argument, let us assume that this is a right view. So now the law has been amended to say that any excess application will not be allowed, will not be treated as application of the subsequent year. So that is very clear on this. Now this, the other, this one was explanation 4, which says that the amount which is spent out of the corpus will not be treated as application of income for that year. See, this is not something only with reference to 11.2 or 11.3 or anything like that. This explanation 4 covers the entire section 11. And this section says that if any amount is spent out of the corpus of income, that will not be treated as application of income for that year. So if out of 80 rupees of the example I had given you, so that is the issue. Okay. Now the next one, please. Next slide. But then the law says that if out of the corpus you have spent some money and in the next year you replenish that corpus out of your current year, next year's income, then to that extent of replenishment will be treated as application. Similarly, when the amount has been spent out of loan or borrowing, it shall not be treated as application of income. According to me, this is something which is quite obvious in section 11 or under any other provisos to section 1023C. See, what section 11 requires you is to apply the income. Suppose, let us say that I have an income of 200 rupees for constructing a building for the purpose of charitable institution. I borrow another 400 rupees and construct a building for 600 rupees. Now, if you look at this fact, the capital asset created is 600. But what is the income applied? Income applied is only 200. It is not 600. You can't apply more than what you have earned. That 400 rupees is out of loan or borrowing, which was never to be treated as application of income. But I do not know whether any of the trusts were claiming that even if the capital expenditure is incurred out of a loan or borrowing, they were claiming it as application blindly without looking into the law and whether the department was allowing or any, because there is a board circular which says very clearly that in the case of loans, repayments, then it will be treated as application of income. Okay. But anyway, the law has now been made explicitly clear, saying that the repayment of such loan shall be treated as allowed as application, provided again the repayment should be out of income earned in the next year. It cannot be out of a fresh borrowal. So therefore, the application of income can only be out of income, not out of the borrowal. Next slide, please. Now, one issue I would like to discuss is this. What happens if you have a deficit in the earlier years? You are carrying on some activities. You have, I'm talking about, when I talk about deficit, I'm talking about deficit which is arrived at on the basis of the commercial principles accounting. To run your education, to run your institution, you have incurred expenses which are normal revenue expenses, which would be normally be deducted from your income, and the balance will be the net income. Okay, this is what will be exempt under section 11. Normal administrative expenses, etc., which you have incurred, which are not normally considered as application of income, if they exceed your receipts for that year, there will be a deficit. Here also, the courts have held that such a deficit can be carried forward to the next year and adjusted against the income of that year, and the balance alone needs to be applied. So the department used to say there is no provision for carry forward, like section chapter 6 dealing with section 72, 72A, 73, there are no carry forward provisions for charitable institutions. The absence of carry forward, you cannot do that. The courts rejected this argument by saying that those provisions are not applicable while computing the income under Section 11. The board itself has said that it is the commercial income which needs to be done. In determination of commercial income, you have to carry forward the deficit and reduce your current year income accordingly, set it off against the current year income. And mind you, this explanation 5 does not cover such deficit. It covers only excess application. There is a difference between excess application and the deficit. So deficit is not touched by this amendment. What is sought to be plugged is only the claiming the excess application as application of the subsequent year. Next one, please. Yeah, before this, just go 2 slides back. Just one more slide back. We'll go to the amendment itself. I just want to know that loan or borrowing only. Please go to that slide only. Yeah. The amount which has been spent out of loan or borrowing shall not be treated as application of income. Okay. Now assume that a charitable institution which is registered as a Section 8 company of the 2023 Act or Section 25 company of the 1956 Act issues debentures and spend some money out of that, subject to this. Now, the Supreme Court recently in Aqua said that when you convert the outstanding interest into debentures, it is not conversion of the outstanding interest to loan or borrowing. For some strange reason, with due respect to the court, I think that's not a right decision, but they have held so. And what has happened? The Finance Bill 2022 proposes to amend Section 43B by not treating the debentures as a loan or borrowing. They do not add an explanation which says that for the purpose of this section, loan or borrowing shall include a debentures, conversion of interest into debentures. What they are saying is conversion of interest, unpaid interest into a loan or borrowing or debentures will not be treated as the interest, treated as interest having been paid. So what they are doing is they are in effect accepting the Supreme Court judgment, saying that there's a difference between a debenture and a loan or borrowing, and therefore normally a loan or borrowing shall not include debentures. So therefore, can I use the same argument here to say that I'm a company, I've issued debentures and I have spent out of that, and therefore it is not out of loan or borrowing? It's an issue, but as I said earlier, my personal view is that the decision of the Supreme Court in Aqua is not the right decision, because under any sense of the term, a debenture is a borrower. As an accountant, I treat it on the liability side under either a secured loan or unsecured loan. What is a loan or borrowing? I take money from somebody with an obligation to repay that money over a period of time. That is a loan. So therefore, subject to that, there is one interesting issue flowing out of the Supreme Court judgment in Aqua. Now I will take questions on this, because, and after the questions, I will stop today's discussion and we can have it next week when you do that. Okay.
Sure, sir, we can do that.
Yeah.
Yes, so I'll just read out the questions. 1 minute. This question, I think I will just allow Mr. Lalit to speak. What would be the taxability of other receipts like interest, etc., which is quite obvious to any institution? In my humble opinion, it would defeat the purpose of the exemption. Therefore, should be interpreted accordingly. So when you able to question, maybe I
no,
just
this point I had already seen it earlier, and I answered that. I only said that I gave the 2 views possible on that, but I will not say that the view expressed saying that the other receipts which are not connected with the institution are not to be exempt. I'm not saying no, that is not a right view at all on that. But all I said is that I have not applied my mind to this issue. I need to look at section 11.7 whether to see whether you can have a separate this one on this or not for registration for that under section 12A. And I think Sharmaji was saying, referring to some Supreme Court judgment on this.
Sharmaji? Sharmaji, you're there?
Okay, fine. So I agree with the views expressed by them, saying that it's a possible view. But
No,
unfortunately,
but,
the court has not looked into.
Yeah, sir, as you rightly said, you rightly said that now because of amendment, both may not be possible now.
Yeah, that's a possibility.
And Supreme Court, I was saying about the excess application.
Okay.
Yeah.
What they have said, sir, I am not aware of that.
No, that Subro's judgment, you can excess application, you can set it off in the next year. But as you rightly said, now there is an amendment which says that you cannot say consider the excess application. Question will be, sir, all past excess application that now they will just go lapse.
That will lapse provided you not set it off.
Yeah.
Because this is not a retrospective amendment. This is only a prospective amendment.
Correct. Right.
Yeah, if it is unutilized, then it will simply lapse.
Yeah. That is Subro's judgment is there, sir.
Okay, sir. Thank you. I'll have a look at it.
Yes, sir.
Sir, the next question is...
next one question I have asked is, you said deficit can be carried forward. But generally, this all administrative expenses we take as an object of the trust only. For example, we are running a school or college. Then only that salary, etc., rent, etc., everything will be on the object only. Sir. What is in your mind when you say that which nature of administrative expense?
No, I'm only saying this. What happens is that, see, in your example which you gave in the case of a educational institution, it is very likely that all expenses, most of the expenses would be either a revenue expense for the purpose of the objects of the trust, that is towards education, like salary paid to the teachers, exam fees paid, printing and stationery purchase, everything, rent paid, everything. Most of them are likely to be that. But there can also be certain situations where, for instance, if you are carrying on a business and you are not covered by the that particular limb of section definition, that the object of general public utility, if you are doing a medical relief, etc., you may carry on a business, there will be deficit.
Okay.
So in that case, and also you see the point is, the board has held that it is the commercial income which needs to be taken into account, and the courts have accepted that, saying what is the income referred to in section 11 is the commercial income. What is the general meaning of the word income? General meaning of the word income is something which is left after meeting all the necessary expenses from the receipts, from the income. Therefore, my view is that there can be certain situations where the revenue expenses can be treated as an application of income. There can also be certain situations where revenue expenses need not be treated as application of income, but as an expenditure which is needed to earn the income.
Right. Yeah, you are right. If business is carried on related to
Yes, there could be a deficit.
Business. Yeah. Appreciates.
So we'll go to the next question. So this question is for how many years can we carry it forward?
Which one?
Arpit's question. I will.
Is it deficit? No, anyway, excess application is out of question, no carry forward. Deficit you can carry forward any number of years. There is no specific provision like section 72 says you can carry forward only for 8 years or anything like that. This is on general principles that the current year income is after setting off the deficits.
Done, sir. Then this is Mr. Rakesh supplementary question to Sharmaji's point. All expenses are disclosed for objects of the trust in educational and medical trusts. Then for educational trust, expenses would be for earning the fees. Same for medical trust.
See, that is a point of debate. According to me, there is, when you pay, you can't educate people without paying salary to the teachers. You can't pay without having your lab or you're having examinations and other attendant expenses. So these are all towards the objects of the trust. Objects of trust is to provide education. So any expenses incurred towards that is on. You cannot narrowly view it and say that unless I incur the expenses, I won't earn the fees. That is not right. Because there can be an issue where I don't even get the fees. I may get only donations from outsiders. I may give 100% education free to the students. I'll incur all these expenses, but my source of income is donations from public and not fees from students. In such case, you can't say that I have incurred these expenses to earn the donation. Donation is given by somebody out of his volition. So therefore, it can be, my view is very clear on this. Under certain circumstances, the revenue expenses can be treated as application, because I will come to that later, because in the Finance Bill 2022, Section 1310 impliedly recognizes that certain expenses can be of revenue nature, which are application of income. When we discuss Section 1310, we will be able to appreciate that point much better.
Sir, do we take more questions, or do we halt here?
I'm sorry, as I told you, this unfortunately this appointment came is something which I'm not able to postpone. So since we are going to have another session, we will start with those questions first, finish them, and then go to the next topic.
Right, sir.
So I request, I'm extremely sorry to all the participants. I apologize for this inconvenience caused them. Otherwise, I should have spent at least another about half an hour with you and could have taken all this matters. But I would like to say that I learned a lot, because there are a few issues which I had not thought about, which the participants have thrown up. So I will go back and think about it. And I thank the participants for that.
Sir, only one or two questions you need not answer today. I will just give you, you must have, if you have 1 minute, sir.
Yeah. Yes, sir.
Yeah. Sir, first of all, suppose a medical institution, they are running pharmacy, or say it is an eye hospital, and they are running a spectacle shop. So what will be that? It will be under 11.4a, and the separate books will be must, or
yes,
because Bombay High Court judgment is also there, it should be must, right? So
yeah, it's 11.4a. It's 11.4a. There is no issue on that.
Yeah, okay.
11.4a will apply.
Yeah. Sir, this 11, now this you can consider, you must have already considered because you spoke on this. Now, this accumulation to be spent in, say, 5 years instead of 6 years. This amendment comes from 1.4.23. So, from what is the significance of 1.4.23? All past accumulation also it will be it. Suppose last 4 years is there, and next year it will be.
Yeah, I will answer this question when I deal with 11.3, because some of the participants may not be able to link immediately to 11.3. I'll keep this in mind, and I will definitely address this issue when I come to 11.3.
Yeah, okay. And last, sir, one in the Bombay, this has arisen in many cases. Salary grant there is the educational institution receive. What department says is, because you have to spend 100% of the salary grant, then this 15% on salary grant, you will not get it. You will have to check it, sir. Yeah, you may check it.
Totally wrong.
Achha.
No, Supreme Court decision is very clear on that. It is 15% of the gross receipts.
But whether
whether it is right or wrong, this is 15% of the gross receipts.
If anything is there, you can elaborate next time, sir, please.
Yeah, I will do that. Okay.